Come with me now. Come with me now. I'm gonna take you down. Come with me now. I'm gonna show you how. Come with me now.
All right, welcome back to our continuation of financial markets. As an example of a financial market, if you've ever bought a car, you probably needed a loan. So where do you get the money for a new car? You would get it from a dealership or a bank or some other entity. And so really, we continue to see that financial markets are very important in the economy. If without them, people can't buy new cars, they can't buy homes, businesses can't start up, all kinds of things. So we're going to continue talking about financial markets today. Okay? You should, by the end of this, understand how financial markets help the economy and which financial tools are key for the macroeconomy. This information, during this lecture, we're also going to learn a couple of calculations. For example, how to calculate the interest rate on a bond or how to calculate the price of a bond. All right, your assignment is the Unit 4 Lesson 2 Financial Markets assignment in Blackboard. All right, so how do financial markets help the economy? Well, basically, they're financial intermediaries in that they help savers and borrowers hook up. It's almost like a tender for money, okay? An example of that would be banks. Okay, banks are private firms, they accept deposits, and then they take those deposits and they give out loans to businesses or individuals or governments even. So the importance of this is that banks are at the center of financial markets. They're very, very important because they help connect the borrowers with the savers. Okay? Now, we're going to learn the different, there's a couple different types of finance, okay? There's indirect and then there's direct finance. Indirect finance occurs when savers deposit funds into an institution and then that institution loans those funds to the borrowers. So the saver and the borrower never meet. Hence, we call that indirect finance. Okay? Direct finance is when firms sell a security, a stock or a bond, for example, directly to the public in exchange for funds. So direct finance is where the saver and the borrower meet. Okay? They're exchanging the money directly with each other. Okay? So as an example, if you borrow money from your parents, well, that's a direct loan because the parents are giving you directly the money. Okay? So here's some examples. Let's see if we can answer these questions. So we're going to refer back to our hands-free selfie stick. So in order to get this production off the ground, you first have to get some money. So if you borrow money from your father-in-law, would that be direct or indirect? It would be direct, because he would be giving you the money directly. If you take out a loan from the local bank, is the bank loaning you its money or is the bank loaning you its depositors' money? That's the difference. So that would be an indirect finance. If you decide you're going to sell bonds to people in your economics class, okay, now you're getting money directly from the individuals that have the money. So that would be direct. Or how about this one? You go on Shark Tank and Mark Cuban loans you the money. That would also be direct. So really, I mean, it's kind of a rule of thumb, but the only indirect finance is when you get money from banks because the banks get the money from savers. Okay? All right, so some financial tools. What are all the various financial tools that facilitate exchange between savers and borrowers? Okay? They could be bonds, stocks, although stocks are a little bit different. They actually are ownership in a company. So they're not exactly savers and borrowers, okay? But it's close enough. We have treasury securities, home mortgages, private sector securities. There's actually securitization now for student loans. So we'll talk about that in a second. All right, bonds. So bonds are used by large established firms or even governments, okay? So this is a way that you could raise money for your hands-free selfie stick. Securities are issued and sold to the public. Okay, this would be direct finance because the business is going to sell the bonds directly to individuals who have money and they want to earn interest on that money. So it would be direct finance. Okay? A bond is an actual IOU. Okay? It means that if you're holding the bond, the business or the entity that is taking your money now owes you that money back with interest. Okay? So here's an example of a bond. Okay, note it'll always have the name of the borrower on it. So in this case, it's McDonald's Corporation. They owe the $1,000 to the bearer of the bond at maturity. Okay, speaking of maturity, number 2, the repayment date. So this particular bond is payable on whatever date, 1993. And the amount due at repayment. This is the face value of the bond. It's also called a par value. Okay. So, bond buyers are savers. They are people that want to earn a higher interest rate than they could in a savings account. Okay. No big deal there. Now, so they want to earn the highest interest rate possible. When we start looking at how the interest rate is calculated, you're going to discover that the price of the bond is what determines the interest rate. So a bond holder, in other words, the one buying the bond, the saver, wants to pay a very low price for the bond. The lower the price versus the par value, the better the interest rate for the saver. Okay? Bond sellers will try to sell the bond at the highest price possible, which means the interest rate would be low. Okay? And that makes sense. So, back to our hands-free selfie stick. To determine the interest rate, you take the face value of the bond and you subtract the price at inception. Then you multiply that by 100. Then you divide that by the price at inception, and that gives you the interest rate. So, for example, Amy Schumer decides she's going to buy a $1,000 bond for your hands-free selfie stick company, and the price y'all agree upon is $800. This bond matures in 1 year, and so what is the interest rate? Well, we take the face value, which is $1,000, and then we subtract the price at inception, which is $800, and then we divide by the price at inception, which is $800, and we determine that the interest rate is, I guess I better use the calculator. Looks like it's 25%, but let's double check. 200 divided by 800 times 1,000 or 100 is 25%. Very good. Okay? So that's how you would calculate the interest rate for that bond. Now, let's do another one. The par value is 1,000 and the price of the bond is $975. So our formula is up here. We're going to take the face value, which is 1,000. We're going to subtract the $975, which is what the bond costs, okay? And then we're going to subtract by the $975. By the way, let's multiply this guy by 100. That'll give us our interest rate. So in this case, it's going to be 25 divided by 975 times 100, and I get 2.56%. So that's our interest rate on this particular bond. Okay? Now, there's another thing we can calculate. What if we're told the face value is 1,000 and the bond pays 10% per year? Then, how do we calculate the price at inception? So, to get that one, you take the face value. In this case, it's 1,000. And you're going to divide that by 1 plus the interest rate divided by 100. So, basically, the interest rate, the interest rate is 10%. Divided by 100. Essentially, all we're doing here is we're saying we're going to divide that 1,000 by 1.1%, or 1.1, okay? And that's going to give us the price at inception. So 1,000 divided by 1.1 gives us 909. So this particular bond should be priced at 909 and 9 cents to be exact. And if it pays 10%, then in a year, the bond should be worth $1,000. Now, you'll have to do this on your homework. Now, there is risk in bonds. There's 2 possible outcomes for a bond. Okay, so think about you're buying a bond for the hands-free selfie stick company. How successful do you think that product would be? I'm guessing it wouldn't be very successful at all, and that company could actually go out of business. If that's the case, then guess what happens to the value of your bond? It drops to zero. Okay, so there's two outcomes for a bond. At maturity, you can get your money back with interest, or it could go into default. And so that's why there's risk. So the more the risk, the greater the interest rate will be. Okay, as an example, look at Greek debt. Back when they started really screwing themselves up, their bonds for their government were paying 4.53%. Today, look at this. This is actually from 2012. Today, I don't even know if anybody would loan them money at all, but back in 2012, their bonds were paying 177% interest. And the reason is because of the risk involved. Okay, so the riskier the bond, the greater the interest rate would have to be. And the reason for that is because to actually give somebody incentive to loan the money to Greece, they have to give them a high reward for doing that. Okay? Now, there are bond ratings agencies that help judge the risk of bonds. Okay? There's various ones: Moody's, Standard & Poor's, Fitch's. The purpose of these rating agencies is to evaluate the risk so that people who would like to save their money in the form of bonds will know exactly how risky they are. Okay, so we have various codes that they'll use. So S&P, they'll have AAA, AA, single A, triple B, double B, single B, triple C, and then they have these Ds that are in default. So the least risky are going to be the AAA. You got Microsoft, Johnson & Johnson, Bank of America, and so on. The more risky ones are going to be these businesses. In fact, these are some that may even be out of business. Is JetBlue still around? I don't know. Okay? So that's the point of those. Now, interestingly enough, the U.S. government's bond rating in the S&P was downgraded in 2011 to AA+. So it turns out Microsoft is less of a risk than the U.S. government. Now, that's AA+ is still fine. There's never been a default on U.S. government debt, so I wouldn't worry about that. Okay. So the price falls when bonds are downgraded. So the bond market actually is another market where bonds are bought and sold. Okay. So for example, we have a bond that is set at a current price of $98,000. If the company or the entity that's issuing the bonds is downgraded, then it becomes a riskier bet. And so the price of those bonds will go down. Okay? So when the price of the bond goes down, what happens to the interest rate? It's going to increase. So we have a very important lesson here, and that is, as bonds increase in price, their interest rates fall, or as interest rates go up, bond prices go down. So what do we need to know there? There is an inverse relationship between the price of a bond and the interest rate that is paid. Okay. Now we're going to talk about stocks. The big difference between a stock and a bond is that bonds represent debt, stocks represent ownership. Now stocks are still used as a means of financing businesses. Okay? They're both used to raise money. Just the big difference is one involves ownership of the company. Bonds represent debt. So stock shares are ownership shares in a firm. So if you own Apple stock, for example, that means you are a part owner of the Apple Corporation. All right? Then we have secondary markets. This is where stocks are bought and sold. Okay, these are important, and the reason they're important is because let's say Apple was the only place you could buy Apple stock. Well, that would also mean that Apple is the only place you could then sell that stock. Okay, if that were the case, I mean, think about a car. What if the only place you could buy a Ford truck was at a Ford dealer? Okay, now that's obviously not the case, right? Because you can buy a used Ford truck from an individual or a used car lot anywhere, right? But what if you could only sell your used Ford truck to a Ford dealer, and then that's the only place you could then buy a Ford truck? the dealer would control that market, basically. They could decide when they want to buy those trucks, and then they could decide when they want to sell those trucks. And that would create an unfair monopoly, basically. So secondary markets are the same thing. Secondary markets is where you would buy stocks, or you could buy bonds, okay? It allows you to sell a stock if you're tired of holding it, or sell a bond before maturity, and so on. And the reason that's important is because it actually increases the value of those stocks. Okay, so if you can sell a stock, that means there's more buyers, there's greater demand, and so you're able to sell it. Okay. So here is why they make them more valuable. Okay. Well, we just discussed this. Secondary markets expose stocks to more buyers. Okay, and basically that just means there's a larger market that might be demanding those stocks. Okay, so there's a higher demand for them. Boom, and so that allows the price to go higher. So that's one reason you might own stock, is so you can sell it later at a higher price. All right, we're going to talk about two other debt instruments that are important, especially going forward in macroeconomics. Treasury securities, these are U.S. government debt. Okay, so instead of loaning money to a corporation, in this case, you'd be loaning money to the U.S. government. Okay, these are very important when we begin talking about monetary policy. And then we also have home mortgage loans. Okay, this is where people borrow money for a home, and instead of making the risk of that one individual borrower paying back that loan, they spread the risk by combining mortgages into one thing that you could then purchase shares of. I'll show you that. Now, real quick, I want to talk about U.S. debt. So right now, our U.S. debt is actually about $19 trillion. Okay? Who is the largest holder of that debt? Well, in 2011, the largest holder was China. Japan's number 2, then you got Brazil, Russia, and so on. These people are holding U.S. bonds. Now, I went ahead and pulled up the more recent numbers. So the most recent number we have is right here. So China still holds about $1.2 trillion worth of our debt. Japan has really increased their holdings to $1.1 trillion. And then we've also added in, the Caribbean banks and the oil exporting nations in the Gulf. So basically, these are the nations that hold U.S. debt. Now, why would they do that? Again, they're going to purchase U.S. debt because it's safe. Okay, they'll always get their money back. Now, let's look at the mortgage-backed securities. Look at how the mortgage market has expanded. Okay, it was relatively flat, or it grew steady. Okay, it grew steady here, but then all of a sudden, it shot up. Now, what that means is home prices went way up, and therefore more home mortgages also went way up. And then in 2007-ish, the mortgage crisis began, and then 2008, we have our big recession. Okay? So what happened is this. Mortgages were securitized, which makes them safer. Okay? But here's the thing, and why would you need to securitize assets? You just answer this question. Would you feel comfortable loaning money to these two guys for a house? Okay? Would you give them $200,000 so they could buy a house? Would that be very safe? Do you think they would be good stewards of that money and that house? Do you think they would pay it back? I'm guessing not. So securitization is where you diversify the risk. It also gives lower interest rates since there's less risk, and it offers new opportunities for lenders as well as borrowers. Okay? So you'll see this in student loan and home mortgage markets. And the fact is that home mortgage markets probably wouldn't even exist if you couldn't spread the risk. So this is very important in our economy. So for example, Lloyd borrows $200,000. Harry borrows $200,000. Sam borrows $200,000. I borrow $200,000, and then other people do. What this securitization does is it combines all of these mortgages into one product that is worth $1 million. And then they cut this into little pieces and they sell shares of it to investors. Okay? That way, no one single entity is on the hook for Lloyd's mortgage. Okay? Or if Walden defaulted on his mortgage, it doesn't hurt one single entity that loaned him the money. It's spread out, okay? So in summary, indirect finance is when savers and lenders utilize banks as middlemen for their loans. Bonds are debt, and then stocks are ownership. That's important. And then you need to make sure you're aware of U.S. Treasury securities. These are bonds that the government issues. So when the government spends more money than it takes in taxes, they sell bonds in order to raise the difference, okay? And they always add to the national debt. So real quick, we're done with the lecture, but if you want to, you can answer these questions. What role do banks play in financial markets? Ding! Banks act as financial intermediaries between borrowers and savers, which is an example of indirect finance. Indirect, let's see. Boom. Ethan deposits money in Blue Bank, and then Jenna takes out a loan from Blue Bank. All right, the interest rate on a bond. What is the right answer there? Boom. It's inversely related to the dollar price of the bond. So make sure you review those formulas, especially while you're doing your homework. What is an advantage of a firm selling stocks instead of selling bonds? Well, if they sell stocks, do they owe anybody money? No, they don't, but they still raise money. So that's kind of a good deal. So stocks don't burden the firm with future debts that must be paid. Why is a secondary market for securities important? Okay, remember the used car market. It's very similar to that. So it increases the value of those securities. They can be resold more easily. And that is the end.